Hey traders, welcome to Charts and Coffee. Happy Friday, everybody. Hope everyone's doing well. We've got end of quarter today. I mean, that's all that really needs to be said. We've got an end of quarter today, which is not quite as intense as year-end window dressing, but it is a window dressing phenomena. For those of you that aren't aware of that jargon, what the heck is window dressing? It's just like it sounds, right? You know, if you're walking down the street and you look at a big picture window for a shop, they're going to put their very best out in front to entice you in. Right now, imagine you're a money manager. You're going to put your very best out in front, meaning the portfolio, to entice new investors in. And what do they want to see? They want to see that you don't hold garbage, and they want to see that you do hold names that they have heard have been outperforming. It really isn't too surprising to think that's going to happen, right? Although, while she will say up and down, window dressing doesn't occur. Come on, we know, and that's okay. And that's okay. We know that the phenomena is going to make strength look stronger. It's going to make weakness look weaker. At the end of the year, we know that window dressing is discussed. We also know that tax loss harvesting is discussed, right? And that's the same phenomena. So depending on the time of year, there might be a different intensity to this window dressing. This time around, and there's always nuance, right? This time around, what we've got is the Federal Reserve in sort of well, they're at the juxtaposition of, do we keep hiking or do we get into cutting? How quickly do we start to message to traders and investors that we're willing to switch to dovish monetary policy? Hawkish monetary policy simply means they're favoring higher rates. Dovish monetary policy means they're favoring lower rates, and hawkish is typically they're hiking, dovish is they're cutting. We had the PCE this morning, right? Let's go jump on over there with the PCE this morning. And what's really interesting about that PCE phenomena is that it is the Federal Reserve's favorite inflation gauge, period. It's the Federal Reserve's favorite inflation gauge. So it's our favorite inflation gauge, right? I looked at this just a bit ago, and we were a little bit higher than we are now. Let me grab my drawing tools here. The expectations for a quarter point hike, which is what this column is, to 500 to 525. And how do we know that? How do we know that's a column for a hike? Well, look at the current target rate. That would represent this column right here to the left. A hike would then be to the right, and that would get us up to 500 to 525 basis points, or 5 to 5.25%. That is mildly the higher expectation for May. Possible, slightly probable, right? But let's face it, it's pretty much neck and neck. And if we don't get the hike in May, come the June meeting, June 14, once again, here is that potential expectation. In fact, even though that's nearly insignificant at about 1 point whatever percent, the fact that the 5.25 to 550 column is even there tells you it's still going into June a little hawkish. So this would still be that quarter point hike. This 4.75 to 5% would be the hold. This, by the way, would be a half point hike. Very unlikely, not even probable, but it's there. And just its appearance does tell us something. All right, so then we move to July, and this is all after the PCE, which came in 1/10 cooler, 1/10 lower than expectations, which does take the pressure off the Federal Reserve to stay with that really intense hawkish messaging. And so getting into July, now we're starting to see this column here, which is, depending on where we end up by the time we get to July, this column is either yet another hold or a quarter point cut. Okay, so not too clear on whether or not July is dovish, but what about September? September 20. This now becomes really the first meeting, beginning of Q3, right? Where there's a possible quarter point cut that's neck and neck with either having cut already or the hold. So you can see the less clarity we have in the near term, the more lack of clarity we have going further out into the year. So what happens in May or June is going to then align what happens with July and September. So we just got to get there. But every piece of data that suggests the economy is okay, inflation's ticking lower, growth is steady, jobs are steady, is going to allow the Fed a couple things. One, they can hike. We're not breaking the economy. Two, if inflation's cooler, it could take the kind of foot off the pedal about just how many more hikes could we see. Probably one more quarter point hike, gang, before we start to cut in September. If we're looking for, all right, Rog, what's the takeaway? That's it. Probably one more quarter point hike before we start to take a look at a possible cut come September. All right, so that's it there. And let's see. Let's do this. Let's jump on over to bonds really quickly because bond yields are going to tell us a lot. We're going to take a look at the long bond and we'll take a look at the 2-year note. And if you read the newsletter, gang, so for those of you that have access to the This Week in the Market newsletter, we're rebooting it. This will be the second issue that comes out later today, probably this late afternoon or evening. And last week, we talked about the impact of the 2-year note and what the long bond tells us. And ultimately, what we're seeing in the long bond, especially after PCE, why would we see a candle like this on the PCE? Because if it came in 1/10 cooler, 1/10 lower than expected, right? That then tells us the Federal Reserve doesn't have to be as hawkish, and that would invite either a hold or cuts even sooner. That's lower yields. Lower yields are going to send bonds and TLT higher, right? That's one thing to look at. Where else could I confirm that? Well, a less hawkish Federal Reserve or possibly a dovish Federal Reserve would then be bearish to the US dollar. Take a look. Quick move higher in the euro. If the euro is moving higher, the US dollar is moving lower. It's that precise an inverse or negative correlation. Euro moves higher, dollar moves lower. Granted, we're taking some of that strength back, but again, you can see the response to that 1/10 cooler number. So if you're ever wondering, what does that mean? A lot of times the number itself doesn't mean anything. Not really. It's how we respond to it. And in the response that we're seeing, it makes life a whole lot easier because now we can see, all right, now we get it. Overall, dollar did head on the response of the data lower, and overall bond yields did head lower. All right, so as always, feel free to type in your questions. And I'm going to move our clock over here. All right, feel free to type in your questions and whatever symbols you want to take a look at. And we'll start off with our YouTube channel here. Hey there, Stacy. All right, so questions. When does the window start to impact on average? I'd say most intensely the beginning of the week for end of quarter. So I'd say most intensely as we go into the last 3 to 5 trading days of the quarter. We probably see little glimpses of it throughout the month, but I'd say most intensely the last 3 to 5 trading days. Yeah, and we could see that with the volatility that we saw this week, right? This was a tricky week. And gosh, this is a tricky month. I was asking, it's really interesting. We were in our daily price movement range masterclass. We were doing a check-in, and I know a lot of you were there live. If you weren't able to catch it live, it will be available in the class resources in the replay, right? And one of the things we talked about, not to mention going through a lot of different ways to understand the daily price movement ranges and use them, was just sort of a general check-in on how with this tool, how with understanding the end of quarter phenomena, how with dealing with the bank crisis, a major pendulum swing in expectations from what the Federal Reserve is going to do, and a myriad of other things, right? How did you fare this month? And I'll tell you, this has been a challenging month. I think it's really important for me to say on this side of the mic and on this side of the camera, this has been a challenging month. Does it have to be a negative month? No way. Is it the kind of month that we blow up accounts? I've never blown up an account. And I say that not in any other way than to credit the only holy grail that there is, which is risk management and position size. Once you understand those calculations, it's just arithmetic. It actually is difficult to blow up an account because you're gauging risk in such a way that you're respecting the amount of money in your account and the amount of risk per trade. Anyway, so I thought, knowing all those things that we taught in the class, I thought I'd ask some of our traders, hey, how'd you do in March, right? And lo and behold, some of them are saying, hey, we're up 10%. I wasn't expecting that. Look, I was going to be happy if they said, look, we're treading water, Rog, we're up a little bit. It's been I was just hoping that everyone's able to manage risk, keep their head above the water, and do okay. When I heard things like we're up 10%, that just reminded me that if we have tools to measure volatility with, we have a way to handle months like March, right? And I think that ultimately, when we have difficult months like March, and it was, right? It's because we're getting unforeseen events, right? Unforeseen events. And obviously the bank crisis was one of them. Even hawkish Powell on day one of Humphrey Hawkins' testimony, it was what, March 7th? That was unforeseen. The markets that thought, what are you talking about? And that was a major adjustment. But remember, most of the time, and I'll talk about it in the newsletter today, most of the time, when the Federal Reserve has to do an about face on monetary policy, they've gone a little bit too far, right? Oops, right? That kind of thing. Whoops, we went too far. Something has to break. And in this case, we could argue that was regional banks. Is that going to be the catalyst for a shift to a hold and start cutting? That is definitely what Fed fund futures and target rate probabilities, as well as the bond market, the notes, 2-year notes, 30-year long bond, that's what they're factoring in. All right, so there is that. All right, next up, and thanks for the question, Stacy. I appreciate that. All right, next up from our training room. Hey there, Ann. Good morning. Can we take a look at gold? Yeah, sure. So let's pull up GC. All right, so taking a look at GC, what we have here, and this was something that Cindy, shout out to Cindy from our Sector Secrets Mastery Room. Cindy said, hey, Rog, after that sort of 5 minutes sort of chill out time after the PCE is gold ashore in the hourly price movement range. If you're looking for automated zones, gang, on your chart for day trading, using volatility is really, really something that ultimately it's going to give you sort of not just a one-dimensional price only type view, but it's going to give you a multi-dimensional, right? So what are the 4 dimensions of the market? Price, time, volatility, and volume. If you can start stacking more of those at the same time, in this case, price, time, and volatility, you're going to find better levels. And I didn't even look at volume, because if we have a volume level, a volume ledge in this area, even better. So that's what happened with PCE, Ann. And then now in terms of what we want to do next, if we're looking longer term, 1 hour, maybe the daily, we're going to be using the daily price movement ranges. We want to see price have to move a whole lot further. So let me show you something else. This is kind of interesting. As a day trade, short term, 5-minute chart, hourly price movement range, it's a quick move to the downside. But if you step back, right? If you step back and say, well, my window isn't quite so short, right? So let's take a look at the 1 hour. Let me zoom in here. Notice there's nothing really to do yet, right? Either we get down to this level here for a buy, which I would really like. I'll tell you what, Ann, that would be something I'd really like to see. That's between 1978 and 1965, 200 exponentials right in there. Beautiful. I would love to do something like that. And if I can't get that zone, I'll day trade it, right? And that starts at around 1988, 1989. So that's what I've got on gold as far as, this post PCE environment. So thanks for the question. All right, next question from our training room is Roku. Hey there, J Cubed. Roku. All right, let's take a peek. All right, taking a look at Roku. Here we go. If I'm not going to day trade Roku, so I'm just going to move that 5 minute aside. We'll take a look at the 1 hour. We'll take a look at the daily. All right, so what do I want to do here? I've got a choppy market. The best thing I can say in terms of clarity regarding Roku is it's already come off a borderline oversold low, right? It's trying to cross through the midline of the stochastic in a neutral environment. I am more bullish than bearish because the trend that preceded was up. So really, I'm looking for a little bit more momentum. What would be a really good level to say we're crossing through a number of stop orders and possibly going to see more upside follow through? Keep an eye on a break of 66.85. J Cubed? I would keep an eye on 66.85 in terms of a potential breakout in a non-trending market. Darvis 2.0 helping out, and the slow stochastic getting through the mid. That's what I keep an eye on there on the daily. Now, if you're looking at the hourly for a shorter term swing trade, I would say oversold. Yeah, you can look for a long position. We just keep bouncing around look at these automated Darvis levels, gang. We just keep bouncing around from one to the next. So this is your resistance zone. Here's your support zone. Let that sync up with the slow stow. In a neutral environment, you're right as rain. All right. Okay, back on over to our Simpler Trading YouTube channel. And let's see here. What do we have? Good morning, Mark. How are you? Spot Forex. Oh, nice. I love Forex. And we're going to talk about the yen today, the carry trade, what the yen means to this environment in the newsletter. Now, I appreciate that. Mark. Thank you so much. All right. Trading some Forex. I love it. All right. Next up is Raphael's asking, can I help me understand the seasonality of oil and natural gas? Sure. So seasonals are tendencies that based on the calendar, right? I mean, a lot of things have a pattern of use, right? We know this. Come cold weather, we expect heating oil to move. Come hot weather and cold weather, we expect natural gas to move. Come summer driving season, we would expect crude oil to move, right? So all these can be tracked. And this particular chart is in the newsletter with an explainer today. And so understanding seasonality, Raphael, the best way to do it is to make sure, and this is so important, to make sure that whatever expectation we have, right, a drop into February, chop through February, March, and a rally coming out of March into April, that the seasonality is syncing up with price action, with syncing up with the trend. And that is not something we are getting right now in natural gas. That is simply not happening right now. So the understanding is, whatever source you're using for your seasonals. I like SeasonX for a number of reasons. But whatever you're using for seasonality, then you've got to go back to the chart. Right? Then you've got to go back to the chart and then start to ask yourself, all right, if I'm supposed to fall in February, check, that happened. If I'm supposed to stabilize in March, kind of happened. And now I'm supposed to start seeing signs of the rally come end of March, not happening. So this is where price and the seasonal have separated. They've disconnected. And that disconnect is obviously where the wheels fall off the wagon. Yeah. Okay. Fantastic. Excellent. All right, gang, that's a wrap. Got 20 minutes goes by so quick. My day trading folks in the day trading room, my sector secrets folks, I'm going to see you in just a moment for our end of quarter morning discussion. All right, we'll see if there are any day trades. We're going to be extremely conservative, extremely cautious, but we'll also take a look at some sector rotation possibilities and as well as sectors that are likely to be unceremoniously potentially dumped today. But what are we going to be thinking about next week, right? It's time to start thinking about next week. New quarter, blank page. All right, gang, be good to each other.